What's up, everybody? Welcome back to Free to Be, and today we're going to be talking about dividend stocks. So this is basically the next step in my tutorial on how to invest in the stock market. Now, if you haven't seen my first video, which goes over some tips for beginners, I'm going to go ahead and link it up above. Make sure you watch that first. But today, my focus is going to be on dividend stocks. What are they, and what do you look for when trying to identify a good one? I'll go over that today. Let's get started. Alright, so what is a dividend stock, right? You've heard this before, I'm sure. Well, a dividend stock is no different than a regular stock. I mean, it's just a share of common stock in a company that pays its shareholders a dividend, a small sum of money on a quarterly or annual basis based on the profits of that company. Alright, so how do you identify them, right? How do you pick the right ones? I want to let you know that if you don't have time to identify on your own, there is a great resource, and I'm going to link it. It's going to be the first link down in the description. This will give you the tools you need to go ahead and invest in yourself and your future. So with that said, let me get right into it. The first tip that you got to be looking for, again, dividend stocks are based on profits. So profits are the most important thing to look at. Consistent profits at that. If you're looking to invest in a company and it's not showing you profits consistently on an annual basis, scratch it off the list, okay? Yes, it's possible for a stock to still pay out dividends if it doesn't have high profits consistently, but that's just, why would you take that risk? Because there's other companies that do have consistent profits. And yes, you could still get paid dividends on companies that don't have high consistent profits, but there's companies out there that do consistently produce profits, so why would you even risk it? Why would you go with something that might not get you the results you want? So always look for profits. And so one thing also to be wary of is high growth rates, because high growth rates just lead to higher expectations, and that just could result in disappointing earnings in the future, which could impact the dividends paid out to the shareholders. Second tip, obviously companies need to have earnings and profits in order to demonstrate growth and to grow, but dividends are paid out based on cash flow, so look there next. A company's got to have strong cash flow. You're going to want to look at their assets, specifically what kind of liquid assets do they have, what kind of purchasing power. You want to look at debt. These are all the factors that determine whether a company is going to be able to pay out their dividends to their shareholders. So the third thing to look for is look for companies that have consistently paid out dividends over a 5-year period, and those dividends have kind of gone up over that period as well. Because this is going to be giving you the best insight into what you can expect in future years, right? If a company has paid dividends 1 year and then didn't pay for 3 years and then paid again, that's not something you want to invest in. You want to see consistent growth in the dividend payments, because that really reflects on how it's going to work out in the future. Your dividends should then theoretically increase as time goes on once you make your investment. It just increases your odds, guys, and ultimately that's what's best for the investor. Alright, so that's the top 3, but I do have some bonus tips. For those who stuck around, I'm going to give you a couple bonus tips that'll help you in this pursuit of dividend stocks. So the first thing you want to do with this bonus tip that I'm going to give you is avoid companies with a massive amount of debt, or really high amounts of debt. It doesn't have to be massive. And I talked about this when you're looking at cash flow, but what are you looking for when you're looking for debt? You're going to want to look to the debt to equity ratio. The debt to equity ratio lets you know exactly what the assets are in play and what the debt is, right? And you're going to want to stay to anything with a debt to equity ratio of 2 or less. Ideally, if you can find them, 1 or less, but if you're under 2, you should be good to go. Second bonus tip is, guys, reinvest your dividends. These are free payments that you're getting. Well, they're not free, but they're payments that you're getting on things you're already invested in. Reinvest them. That's how you're going to get this to grow exponentially. That's how you're going to get the most out of your investments, and by reinvesting your dividends. That's just something that you want to get into the practice of. You want to get into the habit of doing that. All right, well, that's all I got for you guys today. Thank you again for joining me. I hope you enjoyed this video, and if you need help, don't forget to look at the resources down below. Hit the thumbs up button and subscribe. We'll see you next time.